Exactly, Scott. Well put. I'm glad to see the markets are green right now. When the jobs report came out better than expected, futures took a tumble. And that's sort of the environment we've been in, where good news is looked at as bad news because it may provoke the Fed to be more hawkish. I am not of that camp. Good news is good news. And the most important thing is jobs. If consumers have jobs, they will consume healthily. And that's what keeps the economy and the profit picture going. Obviously, Scott, we got to worry about inflation. I can see you looking at me quizzically. Of course, we have to worry.
I am, because of the one thing you said here, that you disagree that it's going to, in your words, provoke the Fed to be more aggressive. This is going to embolden the Fed to do what it wants to do, because it knows, as Powell has said, he has the backdrop of a strong economy to do just that.
Your point is excellently made, and it enables me to be more specific. What the market needs for this to be more than a bear market rally is the Fed to back off. They're not going to do it, Scott, until we get weakening inflation, real true signs of weakening inflation. Now, obviously, we have the CPI next week. I'm actually not expecting a good number. I think it's going to be ugly. What I'm really focusing on is the PPI, because all of this commodity downward price pressure that we've been seeing, crude oil, wheat, lumber, is going to show up first in the PPI. Now, that's Thursday after we get the CPI, and that's really what I'm looking for. But until the Fed shows a sign that it is, even if it's emboldened, not going to act as aggressively as it currently priced in, all rallies are suspect. The point I'm driving at is that really when you look at inventory to sales ratios, you look at supply chains, you look at commodity prices, there is reason to believe that inflation has peaked.
All right, Mr. W, for somebody who's been more optimistic than others, at least you were the last time we spoke, that was about 3 weeks or so ago. Where are you today? What does all this mean to you?
Still optimistic, and I think the narrative towards softer landing is far more prominent than it was 3 weeks ago when we first spoke. I'm looking at data every day of revenue and employment in my own investments in private companies. I have not yet seen the signs of a recession. No slowdown in revenue, no slowdown in our inability to hire people, supply chain getting a little better domestically, a little better. I like to call it the Coca-Cola index. I go into any 7-Eleven store and see how many empty slots there are Gatorade. You never saw that before supply chain's problem. Today, we still have empty Gatorade slots, which tells me supply chain isn't finished yet. I know that's anecdotal, but it's an index I've been using, and it's been working. At the same time, everybody's saying, okay, we're going to have to draw down revenue numbers, draw down earnings numbers. Why? Why? Show me the recession. Bring it on. Bring it on. Not here yet. So meanwhile, back at the farm, I got to invest in stocks. I got to find companies that have been torn to pieces and had their P's crushed. And I don't know if we're at the bottom yet, but these are some really interesting opportunities now, because if you're in the camp that says soft landing Q1, Q2 next year, it's starting to get really interesting for equities. Why not own some? You're not going to make any money owning the 10-year, and it's doggedly staying at 3%, which is, 50% of inflation. So you're losing money owning fixed income.
All right.
Equities are where it's at.
I knew you were going to have a hot take, but why do I need a recession to take down my earnings numbers? Why can't I just have a slowing economy to do just that, and then say that, all right, you're all bulled up because of the jobs report today, which is a lagging indicator. The economy's weaker than the jobs report would suggest, and the Fed is going to still be aggressive, and we still have the risk that they're going to put us into a recession by being as aggressive as they say they are going to be.
Okay, I'm working on a Fed at 50 basis points on the next hike and 25 after that. I think they're looking at commodities rolling over. We'll see what the data looks like next week, but you just have to look at spot prices on futures on any commodity. I don't go pick anything, and you can see it rolling over. You can look at almond prices now. The reason those are down is we have supply chain problems and we can't get them out of the States. We can't ship them anywhere. But those are signs that inflation is rolling over. I don't want to be, always saying the worst is coming, and I'm going to be very cautious, because that gets you a bad outcome.
But you don't have to say that the sky's sunny when the clouds are rolling in either, right? Don't you have to be a realist as to where we are rather than an eternal optimist?